Welcome back to the channel. Today, we're diving deep into the minds of millionaires, uncovering the top 10 investment beliefs that have paved their path to wealth. These aren't just random strategies, these are time-tested principles used by some of the most successful investors out there. If you're serious about building wealth, securing your financial future, and maybe even joining those millionaire ranks, these beliefs are the foundation you need. We're talking about shifting your mindset, understanding the game of wealth creation, and avoiding common pitfalls that hold people back. This isn't about get-rich-quick schemes. We're going to break down each belief, giving you actionable insights you can start implementing today. Remember, building wealth is a marathon, not a sprint. So buckle up, grab your notebooks, and let's unlock the secrets to financial success. The first belief that separates millionaires from the rest is simple: patience. You see, most people want to get rich quick. They chase the latest hot stock, jump into hyped-up investments, and expect to double their money overnight. But millionaires? Millionaires understand that real wealth is built slowly and steadily over time. Think of it like growing an oak tree. You plant the seed, nurture it, and give it time to develop strong roots. You don't expect it to become a towering giant overnight. The same goes for your investments. Millionaires are in it for the long haul. They're not fazed by short-term market fluctuations because they know that over time the market tends to go up. This long-term vision allows them to ride out the storms and come out stronger on the other side. Remember, Rome wasn't built in a day, and neither are million-dollar portfolios. Embrace patience as your secret weapon, and you'll be amazed at the results you achieve in the long run. Now, I know what you might be thinking, Graham, that's all well and good, but I don't have decades to wait around. And you know what? I get it. But here's the thing, chasing quick riches is like playing the lottery. You might get lucky once in a blue moon, but it's not a sustainable strategy for building lasting wealth. Millionaires understand this. They focus on investments with solid fundamentals, companies with strong track records, and assets with long-term growth potential. They're not distracted by the shiny objects that promise unrealistic returns. They're patient, they do their research, and they let their money work for them over time. Remember, slow and steady wins the race. Don't fall into the get-rich-quick trap, it's a recipe for disaster. Alright, moving on to the second millionaire belief, diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, in the world of investing, this couldn't be truer. Millionaires understand that putting all their money into one single stock, industry, or asset class is incredibly risky. What happens if that one investment goes south? You guessed it. Their entire portfolio takes a hit. That's why they diversify. They spread their investments across different asset classes like stocks, bonds, real estate, and maybe even a little bit of gold or crypto. Think of it like having a safety net. If one investment stumbles, the others can help cushion the fall. Now, diversification isn't just about spreading your money around randomly. It's about strategically allocating your investments based on your risk tolerance, time horizon, and financial goals. Millionaires often work with financial advisors to create a well-balanced portfolio that aligns with their individual needs. This might mean investing a larger percentage in stocks if they're younger and have a higher risk tolerance, or shifting towards more conservative investments like bonds as they get closer to retirement. Remember, there's no one-size-fits-all approach to diversification. The key is to find the right balance for you. By diversifying your investments, you're essentially mitigating risk and protecting your hard-earned money. This is how millionaires safeguard their wealth and set themselves up for long-term success. Now let's talk about cash flow. The wealthy focus on building streams of passive income. This means putting your money to work for you. Think of it like buying a vending machine that generates income 24/7. That's the power of cash flow assets. Instead of trading time for money, you're buying money-making machines. The income keeps flowing whether you're working, sleeping, or on vacation. It's like having your own personal money-making army. Eventually, this passive income can exceed your expenses, giving you financial freedom. Building a cash flow empire doesn't happen overnight. It takes time, effort, and a solid strategy. Educate yourself about different cash flow assets. Read books, listen to podcasts, and learn from reputable sources. Determine your risk tolerance and investment goals. Once you understand your investment style, explore options that align with your goals. Diversify your cash flow assets across different classes. Invest in a mix of rental properties, dividend-paying stocks, and peer-to-peer lending platforms. Reinvest a portion of your income back into your cash flow assets. This snowball effect will accelerate your wealth-building journey. Stay patient, stay disciplined, and focus on the long term. One of the biggest mistakes I see people make is investing in things they don't understand. They hear a hot stock tip at a party or get caught up in the hype of the latest cryptocurrency. And you know what? More often than not, they end up losing money. That's why millionaires live by a simple rule: invest in what you know. Focus on industries and businesses that you understand. It's like playing a game where you only bet on the outcomes you can predict. If you're tech savvy, you might have a deeper understanding of the tech industry. This inherent knowledge gives you an edge when it comes to investing in tech companies. The key is to identify your areas of expertise and stick to them. Don't be afraid to pass on investments that fall outside your circle of competence. By investing in what you know, you're reducing your risk and increasing your chances of success. Now, this doesn't mean you should only invest in things you're already an expert in. The beauty of the circle of competence is that it can expand over time. As you learn and grow, so too can your investment horizons. Start by identifying industries or businesses that pique your interest. Then, dedicate time to researching and understanding them. The more you learn, the more confident you'll become in your ability to evaluate investment opportunities. Remember, investing is a continuous learning process. Who knows, you might discover a hidden passion or uncover a lucrative investment opportunity. In the world of investing, knowledge is power. You wouldn't buy a car without doing your research, would you? The same goes for investing. Staying informed is crucial for making smart investment decisions. Read financial news, attend conferences, and listen to podcasts. The investment landscape is constantly evolving. New trends emerge, market conditions change. Staying informed helps you adapt and make adjustments. Mitigate risk and increase your chances of success. Make informed decisions about buying, selling, or holding. Dedicate time to staying updated on financial news. Subscribe to reputable financial publications. Follow influential investors on social media. Engage in discussions with other investors. Immerse yourself in finance to become more confident. With so much information available, it's easy to get overwhelmed. Be selective about your sources and develop a critical eye. Not everything you read is accurate or relevant. Identify reputable sources of financial information. Be wary of sensationalized headlines or get-rich-quick schemes. Develop a system for filtering the noise. Focus on information relevant to your strategy. Understand the fundamentals and long-term growth potential. Diversify your sources of information. Make independent, well-informed decisions. Let's talk about something crucial for successful investing: having a clear investment strategy. You wouldn't drive across the country without a map, right? A well-defined strategy serves as your financial roadmap. It helps you stay focused and disciplined, especially when the market gets chaotic. You're less likely to get caught up in the hype or panic sell. A clear strategy keeps you on track to achieve your financial goals. So how do you go about creating a winning investment strategy? It starts with identifying your financial goals. Are you saving for retirement, a down payment on a house, your kids' college education? Once you know what you're working towards, you can determine your investment timeline and risk tolerance. Next, you need to decide on your asset allocation. This refers to how you'll divide your investments across different asset classes like stocks, bonds, real estate, and so on. Remember, diversification is key to managing risk. Don't put all your eggs in one basket. Once you have a strategy in place, it's important to review it periodically and make adjustments as needed. Life changes, your financial situation changes, and the market changes, so your strategy should evolve as well. And lastly, don't be afraid to seek help from a financial advisor. They can help you create a personalized strategy tailored to your specific goals and risk tolerance. Remember, building wealth takes time and effort, but with a clear roadmap, you'll be well on your way to achieving your financial dreams. Let's face it, the market can be a wild ride. It's like a roller coaster with its ups and downs. One day it's soaring, the next it's plummeting. But market volatility is normal. It's part of investing. The market reflects the global economy, influenced by many factors, from interest rates and inflation to political events and natural disasters. These create market fluctuations. For new investors, this can be nerve-wracking, but don't panic. Investing is a long game. Timing the market is like predicting the weather. You might get lucky, but you're more likely to get caught in the rain. Embrace volatility as part of the journey. So, how do you handle market volatility without losing your cool? First and foremost, remember your long-term investment strategy. If you've built a diversified portfolio with a long-term perspective, short-term dips in the market shouldn't derail your plans. In fact, market downturns can present excellent buying opportunities. When prices are down, you can buy more shares of quality assets at a discount. Think of it like a sale at your favorite store. You wouldn't avoid a sale, would you? Another key to navigating volatility is to stay informed, but don't obsess over daily market movements. Constantly checking your portfolio can lead to emotional decision-making. Remember, it's not about timing the market, it's about time in the market. And lastly, if you're ever feeling overwhelmed or unsure, don't hesitate to reach out to a financial advisor. They can provide guidance and support, helping you stay the course and make rational decisions even during turbulent times. Remember, investing is a marathon, not a sprint. Let's talk about one of the most powerful concepts in investing: reinvesting your earnings. This is the key to unlocking exponential growth and building significant wealth. It's like a snowball effect where your money makes more money. When you reinvest your earnings, you're buying more of the same asset. And as those assets generate more income, that income gets reinvested, compounding your returns. Over time, this snowball effect can lead to massive growth. Reinvesting your earnings is especially crucial in the early stages of your investing journey. The earlier you start, the more time your money has to compound and grow exponentially. Even small amounts reinvested consistently over time can make a huge difference down the line. Now, I know it can be tempting to spend those dividends or interest payments, especially when you're starting out. But remember, by reinvesting, you're essentially paying your future self. It's like planting seeds today to harvest a bountiful crop in the years to come. Reinvesting also helps you build a solid financial foundation. As your investments grow, so does your net worth and passive income stream. This can provide you with greater financial freedom and security in the long run. So the next time you receive a dividend check or interest payment, resist the urge to splurge. Reinvest those earnings and let the magic of compounding work its wonders. Remember, the key to building wealth is to play the long game, and reinvesting your earnings is one of the smartest moves you can make. All right, let's talk about emotions and investing, two things that should never mix. You see, when fear takes over, it can lead to some pretty irrational decisions. You might panic sell at the worst possible time, locking in losses and missing out on potential rebounds. Think about it. You see the market taking a dip and suddenly your heart rate's up, your palms are sweaty, and you can't hit that sell button fast enough. But here's the thing. Successful investors, they don't let their emotions drive the bus. They stick to their strategy, even when things get bumpy. Remember, the market is a roller coaster. There are going to be ups and downs, twists and turns. But if you've done your research, you believe in your investments long term, a little volatility shouldn't derail your entire plan. Keep your cool, stay focused, and don't let your emotions get the best of you. Now, fear isn't the only emotion that can mess with your investments. Greed can be just as dangerous. You see a stock skyrocketing, everyone's talking about it, and you don't want to miss out. You buy in at the peak, driven by pure FOMO, fear of missing out. But what goes up must come down. That's just the nature of the market. And when that stock inevitably corrects, you're left holding the bag, wondering what went wrong. This is why it's crucial to approach investing with a level head. Don't get caught up in the hype. Remember, investing is a marathon, not a sprint. It's about making calculated decisions based on research and your overall financial goals, not on what everyone else is doing or how quickly you can make a buck. Stick to your plan, avoid emotional triggers, and you'll be much better off in the long run. Now, I talk a lot about DIY investing, and for good reason. It's empowering, it can save you money on fees, and it allows you to be in the driver's seat of your financial future. But there's no shame in admitting when you need a little help. Seeking professional advice from a financial advisor can be incredibly valuable, especially if you're new to investing and feeling overwhelmed. A financial advisor can help you create a solid plan based on your individual goals, risk tolerance, and time horizon. They can break down complex financial concepts into digestible pieces, making the whole process feel less intimidating. Second, if you simply don't have the time or desire to actively manage your investments, a financial advisor can take the reins and handle everything for you. They'll monitor your portfolio, make adjustments as needed, and keep you updated on your progress without you having to lift a finger. Of course, not all financial advisors are created equal. You want to find someone who's trustworthy, experienced, and has your best interests at heart. Look for a fiduciary, which means they're legally obligated to put your needs first. Do your research, ask for referrals, and interview multiple advisors before making a decision. Remember, this is a big decision, and you want to make sure you're working with someone who you feel comfortable with and who understands your financial goals. Don't be afraid to ask tough questions about their fees, investment philosophy, and experience working with clients like you. A good advisor will be transparent, communicative, and genuinely invested in helping you succeed. There you have it, the 10 investment beliefs that have helped countless individuals build wealth and achieve financial freedom. Remember, investing is a journey, not a get-rich-quick scheme. It takes time, patience, and a solid understanding of the fundamental principles. Thanks for watching. If you found these investment beliefs helpful, make sure to like, subscribe, and hit the notification bell for more tips on building wealth. Leave a comment below with your favorite investment belief or any questions you have. See you in the next video.